So you did the grown-up thing. You opened a savings account. Every month you shuffle some cash over, $50, $100, whatever's left after rent and regrettable late-night snacks. You feel good. You're the kind of person who reads personal finance tips on the internet. Very mature, very responsible, probably owns a reusable water bottle. Then one day, you're scrolling through your banking app, basking in the glow of your own discipline, and something catches your eye. Your savings account, this thing you've been dutifully feeding like a Tamagotchi, has rewarded your loyalty with 0.5% interest. After 12 months of staring at that balance, your $10,000 has earned you about enough to buy a slightly above average pizza, maybe with toppings. Meanwhile, everybody and their cousin won't stop talking about investing. Stocks are up, index funds are the move, compound interest is the eighth wonder of the world, and so on. And a tiny, annoying voice in the back of your head starts whispering, "Am I the financially responsible adult here? Or did I just decorate a very boring savings account while inflation quietly ate my lunch?" That voice has a point. Here's a sentence that might sting a little. Saving money alone will almost never make you wealthy. I know, your high school economics teacher just rolled over. But here's the distinction that changes everything. Saving protects your money. Investing grows your money. Two totally different assignments. If savings were a person, they'd be the friend who reminds you to wear a helmet. If investing were a person, they'd be the slightly chaotic friend who convinced you to start a business and now you both own a jet ski. You need both. A lot of smart, disciplined people hit a wall right here. They've mastered the saving part. The investing part still feels like walking into a casino blindfolded. So today, we're going to connect those two worlds without the blindfold, without the casino, and without requiring you to read a 400-page book with a lighthouse on the cover. My name is Jack. I explore how your brain, your money, and your decisions actually work, usually in ways you never signed up for. If you've got savings but the word investing still makes your palms a little clammy, hit subscribe. We're about to fix that. Okay, let's get the spicy take out of the way early. Your savings account, the thing you've been treating like a financial teddy bear, is not building your future. It's a storage unit. A very safe, very boring storage unit where your money sits in a corner and politely forgets to grow. Now, don't misunderstand me. Saving is step one. It's the concrete slab you pour before you build the actual house. Skip the slab and your house slides into a mud puddle. But if all you ever do is pour a slab and stare at it proudly, congratulations, you now own an exceptionally flat piece of concrete and nowhere to sleep. Let me show you why this matters with some numbers, and I promise these are the only real math you need today. Say you've got $10,000 tucked away. In a typical savings account paying 1%, which, let's be honest, is practically a high-interest account these days, after 1 year, you have $10,100. After 20 years, you're looking at roughly $12,000. Adjust for inflation, and your money didn't grow. It just politely aged, like an avocado you forgot about. Now, same $10,000, same you, but this time it's invested in something like the S&P 500, which is just a big basket of America's 500 biggest companies. Historically, over long stretches, that basket has returned about 10% per year on average. After 1 year, you've got $11,000, already beating the savings account by $900. After 20 years, roughly $67,000. Let that sit for a second. Same starting line, same amount of effort on your part. Actually, zero extra effort. You were probably napping. One path gave you $12,000. The other gave you $67,000. The only variable was where the money lived. And here's the quiet tragedy nobody warns you about. The biggest financial gap in most people's lives isn't between spenders and savers. It's between savers and investors. Two people, identical paychecks, identical discipline, But one discovered this transition in their 20s, and the other is still treating their savings account like a retirement plan at 45. Decades later, they might as well live on different planets. So if the math is this straightforward, and it is, why isn't everybody doing it? The answer isn't complexity. It's your brain. Saving feels like a warm blanket. The number in your savings account is the same today as it was yesterday, and it will be the same tomorrow. Predictable, unbothered, moisturized, thriving, even if it's not. Investing, on the other hand, feels like strapping your money to a horse and hoping it gallops in the right direction. Numbers bounce, sometimes up, sometimes down. A guy in a suit in a different time zone says 3 words, and suddenly your portfolio is doing gymnastics.
Behavioral economists have a name for why this terrifies us: loss aversion. Humans experience losses about twice as powerfully as we enjoy equivalent gains. Your brain would rather dodge a $100 punch than catch a $200 high five. This reflex was super useful back when losing your supply of dried fish meant starving to death. It is significantly less useful when the loss is a temporary dip in an index fund you won't touch for 20 years. But your brain doesn't know the difference. It just sees red and screams. There's a second gremlin at play too: status quo bias. Your brain treats whatever you're currently doing as the correct default, even when the evidence is standing on a chair waving its arms. Your savings account is the status quo. It's comfortable. It's familiar. It has never once surprised you with a terrifying notification. And so your brain fights to keep things exactly the way they are, because change, even positive change, feels like a threat.
Let me put this in Jack terms. Saving money is like storing seeds in a mason jar. They're safe. Nothing can get to them. No bugs, no weather, no squirrels with questionable motives. But absolutely nothing grows either. Investing is like finally taking those seeds out of the jar and planting them in actual dirt. At first, it looks like you just made a mess. Days pass and nothing happens. Then it rains too hard and you panic. Then a weird bug shows up and you question every decision that led you here. But then, slowly, quietly, on its own schedule, something green pushes through the soil. And over time, you end up with a garden that's worth more than the original jar of seeds ever could have been. Most people never plant the seeds. Not because they don't get how soil works, because the jar feels safer than the weather. And honestly, that makes sense. If you've been building your savings for years and someone tells you to just start investing, it feels like they're asking you to hand over your hard work to a stranger and hope for the best. So let's not do that. Let's do this in steps, each one designed to keep your anxiety low and your odds high. Step 1 is the least glamorous financial advice you will ever receive, and also the most important. Before you move a single cent into the investing world, you need something sitting in a plain old savings account that equals 3 to 6 months of your living expenses. Cash. Liquid. Boring. And when I say real emergency fund, I do not mean my credit card is my emergency fund. That's not an emergency fund. That's an emergency loan with a 24% APR and a superiority complex. I'm talking about actual money sitting in an actual account doing nothing except waiting for the universe to inconvenience you. Here's why this matters, and it's not the reason most people give. An emergency fund doesn't just protect you from life's nonsense. Car breakdowns, sudden job loss, surprise dental work, the usual hits. It protects your investments from you. The number one reason people sell their investments at a catastrophic loss isn't that the market tanked. It's that they needed the cash right then, couldn't wait. Their alternator died and their landlord wants rent, and suddenly they're cashing out investments at the worst possible moment because they had no buffer between their life and their portfolio.
Think of your emergency fund as the bouncer at the club. It handles the trouble at the door so your investments can keep dancing inside. You don't want to drag your long-term wealth into a short-term problem. That's like using a wedding cake as a doorstop. It works, technically, but something beautiful just got racked for a job it was never supposed to do. This money stays in savings forever. It's not for a market dip. It's not for a can't-miss opportunity. It's for the moment life decides to test your structural integrity.
Step 2 sounds like a self-help podcast, but trust me on this. You need to split your money into 2 separate identities in your head. Right now, most people treat all their money as one big blob labeled "Do Not Touch," very important, unknown purpose. And from that blob, the thought of moving any of it into something that fluctuates feels irresponsible. So nothing ever moves. The blob just sits there, blobbing.
Instead, picture 2 buckets. Bucket 1, safety money. This is your emergency fund, plus any cash you'll need in the next couple of years. Its entire personality is stability. It never goes on adventures. It doesn't even own a passport. Its job is to be there when you reach for it. Same number, same face every single time. Bucket 2, growth money. This money has a different mission. Its job is to compound over decades. It is allowed to have bad months. It's allowed to dip. In fact, dips are part of its process, like a sourdough starter that looks gross at first, but eventually produces beautiful bread. When bucket 2 drops 5%, that's not a malfunction. That's Tuesday. Over long enough time horizons, the line goes up, but the path getting there looks like a toddler's drawing of a mountain range. The moment you genuinely internalize this split, something shifts. You stop checking your growth money every morning while brushing your teeth. You stop panicking when some financial news headline uses all caps. You let each bucket do its job without trying to make growth money act like safety money, which is like getting upset that your microwave won't vacuum the floor. Step 3, start tiny, microscopic even. Most beginners think investing requires a Scrooge McDuck pile of capital. It doesn't. These days, you can open a brokerage account and start with $50, $100. Literally, the cost of 2 people eating at a mid-tier restaurant where the waiter pretends to be your best friend. And with fractional shares, which are exactly what they sound like, tiny slivers of expensive stocks, you can own a piece of companies like Apple or Microsoft for as little as $1. I did not have this option when I was younger. We had to walk uphill both ways just to buy a full share. The point at this stage is not the returns. The point is wiring the habit into your brain. Start with an amount so small that it barely registers. $50 a month. Whatever feels like it stretches you the tiniest bit without scaring you back into the jar. Once the habit is locked in, you can increase the amount, but the habit has to come first. Habits are like houseplants. You can't just dump a gallon of water on a seedling and hope for the best. You build slowly. Step 4 is where a lot of people trip over their own ambition. They hear stories. Someone's cousin made a fortune on crypto. A guy on Reddit turned $5,000 into a house through options trading. And they jump straight into the deep end of strategies they barely understand. That's not investing. That's gambling with better branding. You don't need to outsmart Wall Street. You don't need to predict which company is the next Apple. You don't need to understand what a bull put spread is. And honestly, saying those words out loud sounds like you're ordering something very specific at a garden center. The simplest, most battle-tested investment for regular people is the index fund. What's an index fund? Imagine buying one tiny slice of the entire economy instead of betting on a single company. The S&P 500 index fund, for instance, holds pieces of about 500 of the largest public companies in the U.S., from the company that makes your phone, to the company that makes the trucks that deliver your phone, to the company that insures the warehouse where your phone sat before you bought it. When the American economy grows, your investment grows with it. When individual companies stumble, they get quietly replaced in the index, like a contestant voted off a reality show. Warren Buffett, who knows slightly more about money than I do, I'll admit, has repeatedly said that for most people, a low-cost S&P 500 index fund is the best investment available. Not because it's thrilling, because over decades, it wins. The historical average yearly return has been around 10 to 12.5% over the last decade. Investments go down as well as up. I'm legally and morally required to say that. But over long enough periods, the direction has been stubbornly, repeatedly upward, like a determined snail, a very wealthy, very slow snail. Step 5, embrace boring. The most powerful investing strategy on the planet has zero drama. It's called consistency. Not predicting crashes, not buying at the perfect bottom, not chasing whatever stock is trending because a celebrity mentioned it on a podcast. Just putting money in every month. Same amount, same day, same index fund, regardless of whether the market is celebrating or throwing a tantrum. Let me show you what consistency actually does. Invest $300 every month into the stock market. Average return, 8% per year. A bit conservative, but let's be safe. After 25 years, you're looking at roughly $285,000. Here's the part that melts brains. You only put in $90,000 of your own cash. The remaining $195,000, that came from your money earning money, which then earned more money while you were literally just living your life and occasionally forgetting you even had this account. Compounding is the closest thing to passive magic I've ever encountered, and I once saw a guy parallel park a minivan in one move.
Now, let me make this even more concrete, because I want this number tattooed on your brain. Meet Sarah. Sarah starts investing $250 a month at age 18. Average return, 8%. By 65, her investment is worth roughly $1.5 million, tax-free if she's using the right account. Now, meet Michael. Michael waits. He tells himself he'll start when he's more established. He finally begins at 28. Same $250 a month, same 8% return. By 65, he's sitting at around $679,000, which is still great, but it's less than half of Sarah's total. Those 10 years Sarah had that Michael didn't, they were worth over $800,000. Not because Sarah was smarter or worked harder or picked better stocks, because she gave compounding a head start. Time in the market beats timing the market so hard it's not even a debate. It's a documentary, and the conclusion has been in for decades. Now, I know there's a thought buzzing around your head right now like a mosquito at a campsite. Jack, what if I finally put my money in the market and it immediately crashes? Valid fear. And also, plot twist, not actually a problem if you play it right. Market crashes are not freak anomalies. They're standard equipment. They've happened dozens of times. They will happen dozens more. The market has survived world wars, pandemics, the collapse of major banks, and whatever was going on with the economy in 2008 that I still can't fully explain at parties. Every single time, it recovered. Every single time, it reached new highs. The market is basically a cockroach with excellent PR. It just keeps going. Here's the counterintuitive part. If you're still in the accumulation phase, meaning you're contributing every month and not cashing out for decades, a market crash is good for you. It means your regular contribution, that same $300, now buys more shares because everything is on sale. When the market eventually recovers, and it will, those extra shares you grabbed at a discount are now worth significantly more. It's like your favorite cereal going on sale the exact week you ran out. You were buying it anyway. Now you just get more boxes. The people who lose money in crashes aren't the ones who held on. They're the ones who panic sold at the bottom because seeing red numbers made their lizard brain hit the eject button. Experience teaches you to see red as a restock signal, not a fire alarm.
This is the difference between someone who's been investing for 2 decades and someone who's been investing for 2 weeks. The veteran is shopping. The rookie is screaming.
All right, let's land this plane. Here's your game plan, all in one place. First, build a 3 to 6 month emergency fund. Cash, safe, boring. This is the moat around your castle. Without it, the first dragon that shows up burns your entire kingdom to the ground. With it, your investments stay protected while you handle whatever nonsense life just handed you. Second, split your money into 2 buckets mentally: safety bucket and growth bucket. Stop expecting your growth money to behave like your safety money. That's like getting annoyed that your dog won't meow. Third, start small. $50 a month. Whatever doesn't scare you. The habit is the goal. The returns can wait. Fourth, keep it simple. Index funds, broad market, low cost. Don't chase hype. Hype is just fear wearing a fancy hat. Fifth, stay consistent and give compounding time. The first few years will feel like you're watching grass grow, if the grass was also occasionally on fire. That's normal. Compounding is a snowball rolling downhill. At the top of the hill, it's tiny and unimpressive, and nobody would pay to watch it. Halfway down, people are starting to notice. At the bottom, you're an avalanche, and suddenly everybody wants to know how you did it. Most people quit at the top of the hill. Don't be most people. Here's the thing I actually want you to take away from all of this. Beyond the steps and the math and the metaphors about jars and snowballs and cereal, saving gives you stability. Stability means you can survive a rough patch without selling your belongings on Facebook Marketplace. That's real. That matters. But investing gives you something different. It gives you options. It gives you the ability to walk away from a job that's draining your soul, to start something you've been dreaming about, to help your parents when they're older. That's freedom. And freedom beats stability in a fight every time. The trick is you need stability first, then you build freedom on top of it. Save to protect, invest to grow. Do both. Start early, stay boring, let time do the heavy lifting. If this helped something click in your brain today, hit that subscribe button. I'm Jack, and every video on this channel is about understanding your money and your mind. Usually at the same time, because those two are tangled up in ways most people never stop to examine. Drop a comment and let me know where you're at. Still building the safety bucket or already watching your growth bucket do its thing? I read the comments and they honestly shape what I explore next. Now go plant some seeds. See you in the next one.